So which type of investments are better, turnkey properties or partnerships? So let me explain what they are and the difference, and we'll go over the numbers, and then you decide what would be a better fit for you. So a turnkey property is basically a property where you can buy it turnkey. What that means is everything is done with the property. The property's already been fixed up, it already has a tenant, and you buy the property with the tenant in there. And usually the company that sells you the property, they offer property management for you. So you buy the property, it already has a tenant, and it already has property management in place. That's often referred to as a turnkey property. So why would somebody want to do a turnkey property? Well, let's say that you are a doctor or a lawyer, you have a high-paying job, and you need to offset some of your taxes. And so your accountant says, hey, you need to go buy some real estate in order to help you offset some of your taxes through depreciation and things like that. Or you've just heard that real estate is a good financial vehicle to building wealth, and so you decide that you want to purchase a property, but you don't have a lot of time in order to select the right property and fix it up and get a tenant and do all the screening and stuff like that. You don't want to hassle with all of that, so you just want to buy a property that is ready to go. That is a turnkey property. And oftentimes these properties are found like in the Midwest, where you can get properties for a lot less expensive than you can like in the coastal cities or the coastal states such as California or New York. So you're looking for a property that you can buy for maybe $100,000, maybe $150 or something like that. You buy it, you either buy it in cash or you get a loan on it, and then you have a tenant in there, and then you are getting rent from this tenant, and you have somebody that's there that's managing it. So that's what turnkey property is. So how much can you expect to gain when you buy a turnkey property? Well, usually people that buy turnkey properties buy them at market value. And so when they buy the property and after paying closing costs, their net worth usually goes down by about $10,000 because of all of the closing costs that they had to pay when they went to buy the property. But then they're usually making some cash flow. If they bought the property all in cash, then what would be going to the bank goes to them in cash flow. And so on a $100,000 property that's rented out for maybe $1,300 per month, they may be making about $1,000 per month in cash flow. And that's pretty good. $1,000 per month. If you put in $100,000 and you got $1,000 per month, that would be $12,000 for the year. So that would be a return of 12% on your money, which isn't bad. That's probably better than your average return in the stock market, because not only would you get the $12,000 per year return on your money, but you would also get appreciation plus tax benefits with depreciation. So you would be making accumulatively probably much better than you would make in the stock market. So after the first year of getting cash flow, you should be able to be back to where you were when you bought the property. And then you wait a few more years and your net worth is going to be higher than when you bought it. And then you also continue to get this cash flow. So you can see why it would be appealing to people that are high income earners to just go ahead and take a chunk of money and go buy a property. Now, if you're buying a turnkey property and you're getting a loan on it, you may get a couple $100 a month in cash flow, and you're still going to need to leave probably about $25,000 to $30,000 into the deal. And then you just need to wait in order for appreciation to happen, but you can still take the benefits of depreciation while you own it. So again, you can see why people are interested in turnkey properties. But now let's compare it to a partnership property. So let's say you find somebody who knows what they're doing with real estate. They know how to find under market value properties, and they know how to get them fixed up and how to increase or force equity through the rehab. So to give you an example, I have a buddy who contacted me the other day, and he said that he was talking with his accountant, and his accountant said that he needs to buy some real estate in order to offset some taxes. So I was telling him some of the different options. He could buy a turnkey property like how I explained, or he could go and he could find the property, he could get it fixed up, he could find a tenant, and he just doesn't have the expertise. He doesn't know how to do that at this point, and so he didn't feel really comfortable doing that. So we talked a little bit more about it, and I gave him this third option, which would be a partnership. So I told him, all right, I'll tell you what I can do. I can find the property well under market value. I'll get it fixed up. I'll get the tenant in there, and then I'll manage the property. But then we split the proceeds. And so he's going to come in with all of the cash. to buy the property. Now we're going to get a hard money lender who's going to lend the majority of the purchase of the property, and then he'll come in with some money in order to help get it fixed up. He'll come in with some money in order to pay for the down payment and things like that. So he's going to come in with about $40,000. We're going to buy the property for about $125,000. We're going to put about $20,000 into fixing it up, and then there's some closing costs when we buy it. There's some closing costs when we refinance it. So I would say our all-in is probably going to be about $160,000. But when we buy this property and we get it fixed up, it should be worth about $220,000. So in this partnership, I'm going to be doing all of the work, but he's going to be providing the funding for us to get the property, for us to get it fixed up, and then we're going to get it refinanced, and then he'll be paid out some portion of what he puts in there. Probably he's going to leave about maybe $20,000 to $30,000 into this deal. So let's say he leaves $30,000 into the deal. Now we're going to keep this property for about 3 years, and then we're going to sell it on a lease option. So when we sell it, we're probably going to sell it for about $240,000. And when we sell it, we're not going to need to pay any closing costs or any realtor fees because we're going to be selling it to the tenant buyer. So our all-in is about $160,000. Over a 3-year period of time, we're probably going to be paying it down to maybe $155,000, and we're going to be selling it for $240,000. And we're probably going to be cash flowing maybe $200 a month on this property because the interest rates are really high right now. So if we have somebody come in and pay us an option fee of $4,000 to be able to buy that property within the next 3 years for $240,000, and we're making a couple $100 a month in cash flow on the property, then 200 times 36 months is going to be about $7,200 plus the $4,000. Now we're about $11,200 plus the $240,000 minus $155,000, which is an additional $85,000. Well, when you add it all up together, it would be $96,200. Well, let's just say that, we don't make all $96,000. Let's say we only make $90,000. So if my buddy comes in and he puts in $30,000 and we keep this property for 3 years and we gain a total of about $90,000 on this investment over the 3-year period of time, well, then he gets $45,000 and I get $45,000. So let me see if I have this right. He puts in $30,000. And in 3 years, he gets back $45,000 in addition to his $30,000. So he gains $45,000 on $30,000 in 3 years. So how much is that? What is that return per year? Well, if you take the $45,000 and you divide it by 3 years, that's $15,000 per year. So he puts in $30,000 and gets $15,000 per year. That's a 50% return per year for 3 years. So now as you looked at both options, whether it's a turnkey property or whether it's a partnership property, which of the two options would you say is a better option for you? Would it be buying a turnkey property and now you're the only owner, or would it be doing a partnership, being able to work with somebody who knows how to buy the property under market value, who can increase the value so that you can earn more money quicker? So if you're interested in either doing deals like this with somebody who knows how to invest in real estate, or if you want to learn yourself how to do your own deals, then go ahead and reach out to me and I can help either do deals with you or I can teach you how to do deals like this. In fact, in October, I'm doing an investor retreat based out of my properties in Costa Rica, where investors that want to learn how to do deals like I do are going to come down there, and I'm going to show them how to find under market valued properties, how to get initial funding, how to get them fixed up, how to find good tenants, and then how to get long-term financing, and then how to manage them. So basically, I'm teaching the basics, but better. So if you want to learn how to build wealth in real estate, go ahead and reach out to me and let me show you how. Anyway, thanks for watching. I hope that you have a fantastic day and good luck investing in real estate.